by way of introduction, my name is Randy Smerik. I've been very fortunate in the sense that I've been able to surround myself with good teams over the years, and I've had 4 startups, and I've been able to have 4 good exits result out of each of those 4. So I've had quite a bit of experience across the database space, mobile social space. I even did a semiconductor company, which I would not recommend ever doing again, especially in this market. But the bottom line, a lot of experience on raising money, growing teams, and making sure that it all results in a good outcome, not only for the teams that are involved, but all the shareholders and the investors. And so this presentation's a little bit different than the other ones you've heard, in the sense that I watched all the presentations this morning and they were great, and everything they said was absolutely true. But one of the themes that they always had was that you have to have tremendous passion, that your heart and soul has to be into everything you do. Every presentation had that theme, and every one of them is right. And every one of them let you know that 24 hours a day, 7 days a week, whatever vision you have for your company, you have to make sure that that's the vision that you're executing on. Otherwise, you won't be successful, right? That's a message that you hear all the time. And I can't stress enough how accurate that is. However, one message that also comes along with that, which should not, the two concepts do not need to be bundled together, is people feel like, well, if you have this passion, you're creating your baby, then that means you should never ever let your baby go. And in this presentation, my job is to let you know that it's okay to have a great baby, grow that baby, and then send the baby on its way, and you'll never see that baby again. And there's nothing wrong with that. In fact, that's exactly what you should do. And so my presentation is going to be a little bit different than some of the other ones you've heard. It's a very practical presentation. I'm going to give you a lot of how-to advice from my experience. I'm going to show you a lot of charts. If anybody's interested in getting a copy of my presentation, just see me afterwards or during the conference. I'd be happy to email it to you, because there's a lot of Excel spreadsheets and things like that you wouldn't be able to write down. So the theme is that as you're thinking about creating a company, or when your company is still very, very young, one of the things that you should be focused on, just as much as creating a quality product, should be how are you going to sell your company. So even before you start your company, you should have an idea of what it's going to mean for you and everybody involved to sell your company. And it should be a business process just like you think about quality or hiring and firing or anything else. And let me tell you why. The bottom line is, for all of you sitting in this room that are creating companies or running companies, one of 4 things is going to happen. The one that, of course, will not happen to anybody in this room is that you could fail. That it doesn't work at all. You raise a bunch of money, you spend a bunch of money, nothing good happens, and you shut the whole thing down. And sadly, as you probably know, that happens more often than we'd like to admit. But we're not going to talk about that one today. The other scenario is that you could create what I call a lifestyle business. What I mean by that is that you love your business, you're continuing to work to grow your business, but you're really not doing it to swing for the fence. You make your $120,000 a year or whatever it is that makes you happy, and you just sort of create a sustainable business that you understand and that it works and it just sort of keeps moving forward. It's your lifestyle, right? That's not what we're talking about here also, and also that is not a model that any investor is going to put any money into. No VC, no angel, nobody out there is going to put money into a company if you say, hey, I just want to run it for the rest of my life and make $120,000 a year. So you're left with the other 2 choices. The other 2 choices are, the way your company is going to wrap up is it's either going to be an M&A or you're going to go IPO. And M&A stands for merger and acquisition, basically means someone buys your company. And so that lets you become liquid. So your investors, your employee, yourself, you can take that stock and equity you had and actually turn it into real money. The other opportunity is an IPO, which is another way of selling your company. You just sell a portion of it and you sell it to the public markets through all sorts of regulation and scrutiny by people like the SEC. But these are really your 4 scenarios when you think about, so here you are, you're going to create a company. It's going to end up being one of these 4 ways. You don't want it to be the first 2, so you have 2 choices. So let's look at the reality of history. So this is a chart that goes back to 1990. It goes up to, I think, 2009. I'm going to show you some charts with more recent data. But you can see that, for those of you in the back, the stuff that's blue is an IPO. The stuff that's yellow is M&A. you can see that mostly things were IPO until around calendar year 2000. That's when the bubble burst, everything broke down. That's when the SEC in the United States really imposed a lot of regulations, made it a lot more difficult to go IPO, hence you see less IPOs happening now. So the reality is for the last 13 years, and I'll show you data in the next slide, in the last 13 years, if your company is going to exit successfully, meaning it doesn't a failure, you're not going to have a lifestyle business, there's a 90% chance that it's going to exit as a result of M&A, meaning someone buys your company. Okay? If we look at more recent data, this goes up to 2011. I just saw data that just came out for 2012, reflects the same trend. It basically stays exactly the same. If you look at across 2011, from 2009 to 2011, again, about 10% of all successful exits are IPO. The other 90% are M&A. So the bottom line is here you all are. You're not doing this for the fun of it. You're doing this to be successful. You're doing it to give a return to yourself, your co-founders, your investors. So there's a 90% chance that if you're actually successful in your mission, it's going to be because somebody bought your company. Now let's talk a little bit about deal size. This is a similar chart. Shows data starting from sort of the end of 2011, back for about 10 years or so, or 6 years, I guess. The blue bar at the very bottom, basically, these are all show the different valuation, meaning, so there's a 90% chance you're going to sell your company if you're successful. So what are you going to sell it for? Those blue bars right there say that you're going to sell it between $0 and $10 million. And then you can see the smaller little sections of each of the columns go up. For me to do the math for you, if you look at the average deal size, in this space, so I picked this chart in particular because I'm assuming that the people in this room, you're creating an internet startup, IT, something in the software space. You're not doing semiconductors. You're not creating the next world's greatest router to beat Cisco. You're probably doing something in social, mobile, video, something along the software side. That's what this chart reflects. So basically, over the last 7 years or so, the average deal size is somewhere between $10 and $12 million. Okay? So these are just facts, right? These are just from the national VC organization that records all of the different exits. So at this point in time, we kind of know two things. If you're successful, 90% chance of an M&A, and you'll probably sell in the space you're in for around $10 or $12 million. Don't lose sight of those numbers. Now, I'm not suggesting that should be your goal. Obviously, your goal should be to sell for $500 million or $10 billion. But you should never lose sight of what the reality of the world is around you. Let's see what Google says. The #1 company that's acquiring companies that such as the space you're in is Google. They acquire more companies than anybody else on the planet. The next biggest one would be EMC. If you don't know EMC, they're a storage company. After that would be AOL, and after that would be Cisco. You can see even second place, you have to add everybody else up to get to where Google is. So they're one of the top guys. So they would be an example of someone that would buy your company. And one of the top guys in the M&A area basically says that 90% of all their transactions, just a coincidence on the statistic, are less than 20 people, and they're also pre-revenue. So less than 20 people, pre-revenue, and they typically sell in the $20 million or lower range. So very much reflects it. No surprise, right? Google buys the most companies, so they would be probably consistent with the statistics that are out there. So again, these are things to think about as you enter your business plan and you make a lot of other business decisions that are out there. And remember the pre-revenue side. Revenue is not always a good thing. One thing I do as my job is I work with companies that want to be bought. And one of the advice I give them, if they haven't generated revenue yet, don't do it unless you really think about it. There's a lot of times where not generating revenue is going to increase the value of your company more than if you do generate revenue. So don't assume that generating revenue is necessarily a good thing. So let's look at the reality versus the hopes and dreams. So as I've said, and I'll say many more times, if you are successful in this room, and if you're an average person, an average success ratio, you're going to be bought, and you're going to be bought for somewhere between $10 and $20 million, let's say. So logic would say, if there's a 90% chance of something occurring if you're successful, like for example, if I said there's a 90% chance you'll be successful in your business if you hire a woman from San Francisco who knows how to code, and you saw statistics that said If you do that, there's a 90% chance you'll be successful. That's what you would do, right? I don't think any of you would hesitate. But yet for some strange reason, when we create our business plans, when we create our companies, we don't stand up and go, how am I going to sell my business right at the very beginning? Because people think that you don't believe. What, you don't love your baby? Your baby is not that great? You want to sell your baby to somebody? Right, so you just don't talk about it because the world has created this aura that you can't talk about exits. Because we're always being told to swing for the fence, right? You're the entrepreneurs, never say die, work 24 hours a day, 7 days a week, which you should, by the way. But this whole swing for the fence and go for the gusto, you have to be very careful of, and I'll explain why. And it has to do with the whole model around getting funded. So ignore the title, that's a mistake, but if you look at everything else, there's a variety of ways that you're going to raise money, or have raised money already. And they kind of go from, I'll say, the easier to the harder. So if you look at the chart, the vertical axis shows your potential for raising money, meaning at the top, you're probably going to raise more money from that person than at the bottom. And then if you go across the horizontal axis, that means how much control is that person going to want to have over you. This isn't a brilliant chart. You raise money from friends and family, they're going to give you $5,000 or $10,000. They're probably not going to have a lot of control over you. They're not going to ask you for updates to your business plan every couple of days. They're not going to be part of your board. You raise $15 million from a traditional VC in Silicon Valley, yes, they're going to be all over you. They're going to be calling you up every week. They're going to want stats reports every week. They're going to know everything that's going on in your business. So as you look at this chart, there's different levels of control they have over you. And one of the key messages that I'm working to give in this presentation is, keep in mind that you're probably going to be bought if you're successful. Keep in mind for about the money I showed you. And so you, the CEOs, or on the management teams of these companies, you want to make sure you maintain as much control as you can over what you do with your company, because people are going to try to influence you. And so there's a lot of steps along the way, from who you hire, to what investors you get, to what strategic relationships you put in place that could affect how you have your outcome in the case of M&A. So what we're going to do is look closely at traditional VCs. And the reason we want to look at them is they're the ones that are going to try to have the most control on you. So basically this next session is a warning session. As you work with traditional VCs, these are things you want to look out for. Not that these VCs are bad, but whenever you do anything, you want to go in with your eyes wide open. So it's not a good versus bad, it's just being educated and being very informed. And it's because traditional VCs, because they give you so much money and they have so much power, they want to put a lot of what they call protective provisions in the term sheets and other documents they give you. And to be very clear, the word protective is protecting them, obviously, right? It's not protecting you in any way, shape, or form. So let's look really quickly at trends in the VC world, and I'll go through this quickly. So this is like, I know you guys probably can't see it in the back, but this goes like over the last 15 years. But the bottom line is the size of VC firms have gotten bigger. So there's less VC firms in general, and they've all gotten bigger. And what I mean by a size of a firm, meaning how much money do they raise? And so it's common now to raise $1 billion or $1.5 billion. It didn't used to be that way 15 years ago. So less number of people raising more money. I'll explain in a moment why you care about this. That then means that the average amount of money that a VC has to invest has gone up. Because if you look at these VC firms, they still have like 4 to 12 partners. It's not like they have now 70 partners because they have more money. They have the same number of partners because they don't want to share control. So they have more money, so just do the math. That means each individual person has more money that they have to put to work, more money that they want to invest in companies. The amount of investment from VCs into an exit has therefore gone up. Because just imagine, I mean, for all of us, we want money, so having money is not a problem. But if you're a VC and you just raised $700 million, the people that put the money in want to see that money go to work. They want to see it go to work so they get a return. So they're under pressure to put that money to work. And so if like 2 years go by and they don't invest much of it, that's a problem. So they really need to put money in. They need to get rid of that money. So what they tend to do is they want to put more and more money into less number of companies that they like a lot. And the end result is that the time from VC investment to the time that there's an exit, in this case these are positive exits, so either M&A or IPO, the time has gone up because they usually try to push you along longer. So this is a very, very important thing for you guys to keep in mind as you work with VCs. This is their model. They're not bad people. Just like when you create your business plan, you have a model for how you're going to grow your community or raise revenue or whatever it's going to be. They have a model also. Just like your board of directors and other people will beat the shit out of you if you don't make your numbers, the LPs, limited partners that are involved in them, they beat the shit out of them just as much. So it just all rolls downhill, right? So this is their model. And the issue is that these VCs that put money in know the limited partners that put money into the VCs know that it's a risky investment. So they want to have at least a hope that they're going to get a big return. They have a hope. And so their expectation is that they're going to have they want to see at least a 20% return year over year, right? That's what they want to be able to believe they have a hope for. And one thing that this is simply a law of statistics, I don't know why it is, but the reality is that the VCs keep track of all these numbers. The reality is approximately 2 in 10 companies actually generate a return, 2 in 10. So when a VC makes an investment and they're looking you in the eye and they tell you how much they love you, they know in their heart that there's a 80% chance you're going to fail. Only 2 in 10. It's just, again, these are just facts of nature, right? For whatever reason. And so what happens is in order to get the returns they need, and because only 2 out of 10 actually succeed, what they need is for those 2 in 10, they have to return a 10x investment. So if they put $2 million into you, they want to get 22 back because they want their 2 million back, and then they want to have a 10x investment on top of that. So when they look at you, they're looking at you in that way. They want to know you have that potential. That's why they don't invest that much into like service companies, because it's hard to have a 10x return on a service company. They want to invest in product companies, technology companies, where there is that potential. That's why they say, well, how big can this market be? Because they want you to be a first mover, the biggest guy in a market that's big, so they have a chance of getting this 10x return. But this is a problem, right, if you haven't done the math already. So for example, a very common scenario, I don't know how many of you have actually gone through the fundraising process, but a very common scenario right now in this world would be, these would be like real VCs, right? Silicon Valley, you're now at Series A, you're not doing seed money anymore. You might raise $2 million on an $8 million pre, okay? What that means is that you just gave 20% of the company to the VC. And they put $2 million in. To get 10x, and the reality is they want more than that, but just to get to 10x, to keep it simple, they need a $20 million return. That just doesn't even give them their money back. At 20% ownership, that means you need to sell the company for $100 million. And as you saw on the previous slide, $100 million doesn't happen every day, right? That's a very, very small percentage. And they know that. They look at all these numbers too. So what are they going to do? They're going to try to make you one of these 2 in 10, and they're going to keep pushing you to be one of those guys at the top. So when you work with VCs, and the message that I'm giving is not, don't work with VCs, they're evil people, stay away from them. They have a lot of money. They have a lot of contacts. They're smart. They can give you great advice. The message is, make sure you go into it with your eyes wide open, meaning when you work with a VC, like in Silicon Valley, where you're raising like $1.5 million or more, you need to make sure your mindset is one where it's go big or go home, right? You're not into this to get, hey, I'm going to get my 6 or 7 million out and I'm done. You're going to be working with somebody who's going to be motivating you and potentially controlling you and potentially replacing you to make sure that this company can be one of those 2 in 10. And the reason is because they have these expectations. And at Series A, they expect like a 10x. Series B, where there's less risk, maybe it's 4 to 7x. Series C, a lot less risk. They're perfectly happy to have a 2 to 3x return. But where we're at right now, we're talking about a Series A. So this gives you a model for what their expectation is. And it all comes down to different perspectives. So here you are, all of us in this room. As you heard this morning, and I do totally agree with them, you have to have nothing but passion. You have to be 100% focused on what you're trying to do. And so that's you in the middle. You're that yellow rectangle, right? And your whole world is this idea. Your whole world is this idea. And oh, by the way, every now and then you got to raise some money. And every now and then you got to update your pitch deck and get some money from these VCs. But your whole world is making this vision happen, hiring the right people, growing the team, building the community, growing customers, beating the competition. That's your whole world. And every now and then you got to work with these investors. Every now and then they bug you for a status update. On the flip side, if you're the VC, and it's always important when you negotiate or work with anybody to think about what it's like to be in their shoes. And that's a lot of what this presentation is all about. If you're a VC, for any one VC, they might have, say, 10, to keep the math simple, 10 active investments around them at that moment in time. You're one of 10, right? They're calling you up every 2 weeks because the rest of the time they're calling up the other guys. You're just 1 in 10, right? And never ever lose sight of the fact that when they're looking at you guys sitting around the table, are they looking at you with a red X on your forehead, or do you have dollar signs on your forehead? You're going to be one or the other. And when it becomes really, really clear you're a red X, then you're not going to hear from them very much anymore. They're definitely not going to put any more money in, that's for sure. But this is their world. And you have to always keep in mind that that's the world of the people that are investing in you. It doesn't make them bad people. They have to do this in order to generate the returns they need in their business model to make their whole ecosystem happen. And as I said, the result then is that VCs may fight way past the time you want to keep going to keep your company going. Because if they sense that you can be one of those 10, even if you want to get out, they're not going to let you. And then you're going to find out that there's these protective provisions. What are they protecting? They're protecting the VC from allowing you to leave when you want to and only leave when they want you to. Again, not bad people. This is just what they need to do. Just like you put clauses in your contracts with your customers. And the way they do this is through different voting classes, articles they put in the term sheet, specific protective provisions. You will see something that says you cannot do a change of control without their permission. You cannot sell unless they say yes. And the reality is there's probably not much you can do about it. The purpose of what I'm talking about here is just to make sure you know. I'm not saying don't take money from them. I'm not saying don't work with them. But I've worked with so many super smart entrepreneurs that didn't know that this was what the world was like until they got a really good offer that they wanted to take, and the VCs were like, no. And they're like, what do you mean no? And that was the very first time in their life that they read the protective provisions. Not that they would have necessarily changed anything, but you don't want to be surprised by anything in business. So let's look what could happen in a real world scenario. Again, I'm happy to send these slides to all of you. So a very real world scenario could be, as I kind of mentioned in a previous example, you may be doing an angel round, right? You're just getting started. Your pre-money valuation is $2 million, right? 2 million, 3 million, somewhere in that range. Very, very common for products that are in the space of most of us here at this conference. And let's say that you raise $500,000. You just do a nice solid angel round, right? You get 250 from one, a bunch of 50,000s, rounded out with a few 10,000s. You get to your $500,000 that you need. In this scenario, basically the way the cap table would work is, in this example, the CEO has 40% of the company, staff has 40, angels have 20%. VCs have nothing because you don't have VCs yet. You have a post-money valuation of 2.5 million. Let's just say then that you do a really, really good job. You execute on your objectives. You're moving the company forward in a really, really nice way. And you're just making it happen, right? The community's doing well, people love what's there. And you decide a year later that now is time to take your company to the next level. And even though Randy warned you about all these VCs and everything else, you got to get the money, right? I mean, where else are you going to go and try to raise a bunch of money? It's hard to do. So you decide that you want to raise $3 million because you're going to open up a bunch of offices, you're going to hire a bunch of people. You have to execute on this opportunity now. And the reality is you probably should if you're really, really doing well. So what you do is you go out and you raise money, and you find out that you can raise money at a $10 million pre-money valuation. 4x increase. You should feel really, really good about yourself. In 1 year, you just increase the value of your company by 4 times. And you found somebody that's going to give you $3 million. They believe in you, and they're going to give you $3 million. That gives you a post-money valuation of 13. So if you then do the cap table over there, you see that, yeah, you had to give up 23% of your company to get that $3 million, but overall, the valuation has gone way up because you have that 4x increase in valuation. So you and everybody else are very, very happy at this point. Now, it's all paper money. You haven't turned it into anything, but you did what you said you were going to do, and now you're funded to really take it to the next level. Another year goes by. you continue to do really, really well. And Google comes along and offers you $40 million for your company. Okay? So Google walks up to the CEO and she goes, talk to me. What does this mean for my team? She asks about what the product's going to be done. And the bottom line is she's happy. They're going to want to grow it. They're going to make it an important part of the strategy. She's going to continue to have a lot of control over growing the team. They're offering her $40 million. So I know none of you guys would do this, but what I would do, and what she did the second that meeting was over, is I would run out and figure out what that means for me. They're going to give me $40 million. And I got my cap table, and I know I have 31% of the company. So you do the math pretty quickly, and you kind of look at it a couple times, and you go, I created this company 2 years ago, and I've done really, really well. And to be honest, I'm not sure if I can keep it going. Competition's getting tough. Maybe I've had to pull a few tricks to have it grow as quick as it did. And damn it, $40 million is not bad. And if Google's going to keep it going and my team's going to continue to be employed, and I get $12 million after 2 years, this sounds like a really, really great deal. And look at my angels and everybody, they're going to make a bunch of money. So if you look at the multiples for the investors, the angels get about a 12x return. And I'll tell you right now, angels are going to be very, very happy with a 12x return. VCs get a 3x return. Great exit for CEO and founders. Angels are happy. More than likely, in this scenario, the VCs will veto that exit. They will not let this go forward. Why? The reason is think about it. Only 2 years have gone by. First year, she was able to grow the company by a 4x valuation. Then Google comes along and wants to buy her for $40 million. That's another 4x increase. I'm sure in the board meetings, she hasn't been going, well, I've been kind of doing some sneaky stuff. Well, I'm really worried about the competition. She's been going, we're kicking ass. She wants the meetings to go well. She wants to get the pat on the head. Maybe she's getting little bonuses along the way. So she hasn't been telling the VC what's going on in her head. She's been saying everything's great. Now keep in mind all this stuff I said at the beginning, because I said it for a reason. The VC's looking around. There's only 2 in 10 that are going to be successful. Is this one of the ones you're going to let out of your hands right away? There's no freaking way. $40 million for this company, it should be $400 million. It should be $4 billion. So more than likely, they're going to say no. And that more than likely, that's probably going to create an issue, and she'll maybe continue to try to keep it going, or maybe they'll replace her, or whatever might be the case. But the thing to keep in mind is, in that first scenario, for a lot of people that are standing here right now, you would never think that someone would say no. How could you possibly say no to this situation? It happens all the time. And then what also happens all the time is you try to go for that $400 million and it doesn't happen. And then you think about that $40 million every single day for the rest of your life. Every single day. No exaggeration. I know lots of people in that space. That's part of why I give this talk here. So the reason I went through all of that was that this is an example, one of many, many examples of where you want to think about what you make decisions on early, because it could affect when you sell. And this is also why VCs don't necessarily want you to go, hey, let's talk about exits, because they don't necessarily want to share all this with you. There's a lot of other things you have to watch out for also, from the very moment you start your company. For example, from the very moment you start your company, you want to really think about making sure everybody signs intellectual property agreements. Because I've seen many, many times where somebody comes along and offers you $40 million for your company, and then the whole deal dies because in due diligence, they find out you don't really own the IP. Your buddy, who was your college roommate, as a favor, worked on it for 6 months, never really signed up, didn't get along with him after that. He went his way, you formed a real company, you got everybody to sign all this stuff, and then he knocks on your door when he hears about the $40 million offer, right? Happens all the time. Another example of something. These are all reasons why you would never start a company without thinking of a marketing plan. You would never not think about who your target audience is. You would never not think about who you want as your founders. So if you think about all the things that could completely screw up your exit, which, by the way, is a 90% probability if you're actually successful, why would you not be thinking about it at the very beginning and every step of the way? There's other things you need to think about. What are other things that buyers care about that you want to be prepared for? So I'm in the business of selling companies and helping people sell companies. There's really 6 things at the end of the day that you really want to be focused on. I mean, there's a lot, but there's sort of a big 6. There's the exciting stuff. So this woman I talked about that was trying to sell her company, or Google wanted to buy it for $40 million, probably the things that got that person excited, meaning the person at Google that wanted to buy it, probably things that got him excited was, first of all, the product. You have to have a good product, right? That's going to be, if you think about fishing, right? You're throwing your hook out there, you have to have a really good worm or you have to have a really good lure. And that's what this size is, right? The first thing they're going to look at is your product. It has to be good, has to be really interesting. And you also want to make sure that it has real intellectual property behind it. And what I mean by that is, there's a lot of companies I work with that come to me and they go, Randy, we're kind of tired, we want to sell, what do we do here? We have this really great product. And what I notice a lot of times is, yeah, they have a really good product, but it's really just a mashup of a lot of other technologies. They really can't point to any algorithm or engine or something that they really develop themselves. It's just a bunch of pieces they kind of glued together to do something interesting. And I'm not saying you can't sell that company, but you're probably not going to sell it for a lot, because there's not a lot that you can build upon. So it's very, very important that when you think about your product, and I've said it 1,000 times, I'll say it one more time, keeping in mind that eventually you need to be bought. That's how you're going to exit. Make sure that the product you have has intellectual property in it that can actually be interesting and described and useful to someone else. So you want to think about, are you based on, for example, Microsoft.net? Nothing against Microsoft, but probably your valuation is going to be lower than if you're not, right? So you just want to think about what your code is that's there. Your team is essential, because more than likely, they're not just buying you for the product you have at that moment in time. They're buying you because they might want to create a whole division around you. And they want to have a team that's going to have critical mass to build that. And they want to know that the roadmap for your product can continue to be executed on. So they definitely want to have a team. And a team is not just a CEO that's really, really aggressive. I mean, they're going to go through really active due diligence. They're going to work with you. They're going to want to interview the team. They're going to want to talk to them. So you have to have a team that really has depth, really understands their functions, and can work very well together. So really look and watch the team you have, and I think you guys already know that. Then the third thing that's always important to keep in mind is at any point in time, you should have a vision. Now, I'm not saying that vision necessarily has to be ability to execute on it within the funding that you have, but you should have a vision at any moment in time that you can articulate. Something big, something grandiose, but yet still within the realm of reason. Because what I see is that as we work an M&A deal, someone will come along and they'll say, hey, we want to buy this company, and we'd like to offer $15 million for it. Because they're looking at just what's above the surface, right? They're looking at the top of the iceberg. And probably $15 million is a realistic thing for that. What you want to be able to do is very quickly go, hey, you know what, that's nice, and I understand why you want to say 15, but let me talk to you about what my vision is and where this company is really going. And if you don't buy us for 30, here's why you're going to lose and why your competition is going to succeed. So your product and your team kind of gets you, I'll say, the valuation you deserve. Having a good vision at any moment in time gets that valuation to go way higher than you deserve for what you've done up until then. The vision is absolutely essential, and it also helps with closing the deal more quickly. So these are the things that get the person excited. And then what happens during an M&A deal, in case you haven't been through one, is let's say this person at Google, maybe the woman is able to get success from the VCs, they say go ahead. They go in and they enter into the term sheet. What happens then is that adult supervision enters the picture. So probably the person that got excited by this is, say, a VP of development, VP of marketing, whoever at Google or whatever company. The adult supervision is going to be the CFO, the VP of business development, someone like that. And they're going to come in with the mindset of, no way, right? I'm coming in to find out everything wrong with this deal for 2 reasons. One is they probably just want to shut it down. The second thing is they're going to try to negotiate to get the price down lower. So what they're going to look at is the boring stuff. They're going to look at IP ownership. So I mentioned before, it's essential to have a lot of solid IP. It's critical that you're able to show very clearly that you own all that IP. I cannot say this strongly enough. It's going to sound like a really, really boring thing right now. You're not going to want to do it. But every human being that comes anywhere near your product, especially coders, marketing, design, anybody, please download a standard intellectual property agreement from the web and have the person sign it. Because as soon as they come on board, if you give them that piece of paper and ask them to sign it, they're just going to sign it. If it's just a standard one, they'll just sign it, no questions asked. But in every deal I get involved in, I guarantee you, the CEO goes, yeah, everybody signed, I was really good, I know all that. And then 2 or 3 people come out of the woodwork. And I'll tell you, you develop an entirely new relationship with someone when you walk up to them and say, Google's about to buy us for $40 million. I just noticed you haven't signed this agreement. Would you mind signing it? You're going to have a discussion with that person that you would never imagine, because that person is probably not just going to sign it. They're going to have a lot of people giving them advice on what they're going to ask for in return for that signature, and it could be a lot. So intellectual property, sign it, have them sign it and save it, please. The cap table, again, even though it sounds really, really boring, companies right now are scared to death about cap tables. They want to know where literally every single share goes, because they have so many deals where they close it all out, they pay out everybody the money, then somebody comes out and goes, well, no, you paid me for 200,000 shares and I had 350,000. And that causes the whole thing to be re-looked at. The SEC gets involved. It's a mess. And so they're very, very cautious on this. So if they see messy IP, so even if you get them all excited with that, adult supervision can easily shut the deal down by not having good intellectual property, not having good cap table. And on the team, even though it's the same words, you want to make sure that the team is a team that is willing to go to a different company, is willing to move if they need to move, etc. So the team is just as important. So you can think about it again. These are all things that you have to do at the very, very beginning. These are all things you need to plan for at the very beginning, but they affect what you're going to do when you sell. That's why I'm warning you about it now. So just to wrap up, in order to be ready for a successful exit, you need to make sure you have those 3 big things, right? You need to make sure you have the product, the team, the vision. Make sure you have the boring stuff. Make sure you have a shared exit strategy. Once you're funded by the VC, it's okay to have a real discussion about exits. Because as you saw with this example I gave with the woman who wanted to sell her company to Google, that happens all the time. And part of the issue was she wasn't having a realistic discussion with her business partners. Be an active player, make sure your options are always open. So the bottom line is as CEO, you don't always want to be just the chief executive officer, be the chief exit officer. Worrying about exits is not a bad thing. It doesn't mean you want to flip your company. It doesn't mean you're a horrible human being because you're thinking about selling your baby even before it's born. It's really not a bad thing. Because 90% of all exits end this way, you'd be crazy not to. So I hope you found it interesting. Let me know if you would like to have the slides and have a successful venture in whatever you do. Thank you.